Hello everyone, we are Group 1. We are presenting the video assessment of SIQ1001. Today we're going to dive into the two companies, which is Mr. DIY and also Padini Holdings. Before we present to investors, please let me introduce our members first. Okay, so first we have the Shu Ting. She is an accountant from the Padini Holdings. And also we have Yanqing. He is the CEO of Padini Holdings. And David, he is the CEO of Mr. DIY, and also John, he is the accountant of Mr. DIY company. We move to our organizer today. First is me, Julian, and I'm the host today. We have Carlen, he is an investor, and also Levin, he is a risk assessor. Okay, before we start to the accountant expense, I think it's crucial for me to overall report. Let's spotlight Mr. DIY's performance for the year. Total revenue hit 4,651,416,000, with Malaysia contributing 4,608,000 and Brunei 43,228,000. After factoring in inter-segment adjustment, our net profit stands at 568,000. Notably, no single customer drives 10% plus of revenue, so major customer data isn't separately disclosed. These figures reflect our market reach and operational strengths, even as we negative cost and growth dynamics. Let's look to the Padini financial standpoint. Okay, so team. Let's break down Padini's financial statement of 2024 results. Group revenue rose to 1,918,847,000, but cost pressures pushed the gross profit down to 695,000. After covering expenses like selling costs and finance charges, net profit for the year landed at 146,000. Year on year, we see revenue growth offset by margin challenges. These numbers highlight our sales momentum and the need to optimize cost structures moving forward. Then let's look into Padini Holdings. Shu Ting, this is your turn to unpack the statement for Padini Holdings company.
From company Padini's cash flows from operating activities. The cash flow logic of operating activities was similar to that of the group. The net cash flow for operating activities in 2024 was 3,633,000, a slight increase compared to 2023, reflecting the stability of the company's operating cash collection, which matched the slight profit growth in the statement of profit or loss. The cash flows from financing activities. Financing activities was mainly focused on dividends paid. The net outflow scale was stable in 2024 and 2023, reflecting the continuity of the cash returns to shareholders. The company focused on existing business, was stable profitability and cash flow, relying mainly on dividends from subsidiaries as a primary cash source. The net cash flow for investing activities in 2024 was 70,921, mainly from the repayments from subsidiaries and dividends received from subsidiaries. In 2023, there was a net outflow from 70,648,000 due to advances to subsidiaries. The fluctuation in the data of the 2 years reflects the characteristics of the fund transaction with subsidiaries. Profit and loss. Revenue increased from the year 2023 to 2024, almost 5.3%. However, the cost of the sales grew at a faster rate, rising from 2023 to 2024, almost increased 10.8%. So for net cash from operating activities was negative 5 ringgit in 2024, a slight worsening from negative 5 million ringgit in 2023. The group generated 1.21 billion ringgit in pre-working capital cash flow, but significant increase in inventories and receivables put it down. Investing activities improved slightly, with 19.8 million ringgit in interest income and only moderate purchases of the PPE, resulting in net outflow of 20.3 million ringgit. Financing cash outflow reached 204 million ringgit, mainly due to dividend payout and lease liabilities. After all, cash movements, cash equivalents increased by 188 million ringgit with their balance and 791 million ringgit showing continuous asset. Base remains liquid despite net operational cash flows. Thank you.
Okay, let's look to Mr. DIY's account and explain. John, this is your turn to explain this.
First, we introduce the cash flow of Mr. DIY. In 2024, Mr. DIY reported a strong net cash flow from operating activities of 935 million, slightly lower than 972 million in 2023. This decline was mainly due to higher tax payments from 189 million to 206 million, and larger inventory and receivables accumulation, which reflects business expansion. The cash used in investing activities increased significantly from 12 million to 35 million, mainly due to higher purchases of property, plant, and equipment from 26 million to 53 million. The financing cash outflow was 204 million, driven by lease payments with 104 million and direct payouts of 76 million. Despite all this, total cash and cash equivalents still increased by 188 million, reaching 791 million at year-end. This confirms that Mr. DIY's strong internal cash generation and financial stability. The third, I will introduce about profit and loss statement of Mr. DIY. Let's begin with the top line. The revenue increased by 292 million ringgit, a 7% of growth, rising from 4.36 billion in 2023 to 4.65 billion in 2024. This reflects our strong performance in sales. However, our cost of sales also rose by 138 million, or around 6% off, which indicates rising production or procurement costs. As a result, our gross profit improved by about 144 million, which is an 8% increase, a health sign. And next, let's look at operating income and expense. Other operating income went up by 12 million, growing 40% off, which could be due to side income streams like rental or service revenue. And the administrative expenses increased by 34 million, and other operating expenses rose by 180 million, both showing over 10% of growth. This indicates that the company is expanding, but at the cost is higher overhead. Even so, our profit from operations still increased by 15 million, a 2% of rise, reaching 845 million in 2024. The finance cost rose slightly by 8 million, a 12% of increase, likely due to higher lease or interest costs. Meanwhile, profit from associates rose sharply by 3 million, a 76% of increase, showing successful partnerships. The profit before tax increased by nearly 10 million, again a small but steady improvement. However, income tax expense also went up by about 2 million, bringing our net profit to around 500 of 69 million, an increase of 8 million, or roughly 1.5% of year over year. And now, for the comprehensive income, there was a foreign currency loss of nearly 1 million, compared to a gain of over 1 million last year, leading to a swing of over 2 million. Therefore, total comprehensive income came to about 568 million, still slightly up from 2022 by about 6 million or 1% off. Lastly, the earning per share stayed consistent at 6 cents for the both basic and diluted, reflecting steady returns to shareholders. In summary, While we saw modest profit growth, the company maintained revenue expansion and profitability despite increased costs. The performance of associates and stable EPS suggested solid long-term fundamentals, through operational efficiency will be key to sustaining margins in the future years. And I will introduce financial statement of Mr. DIY. Let's begin with non-current assets. The total has increased by approximately 165 million ringgit, or 8% of profit, compared to previous year. The first is property, plant, and equipment. It went up by around 55 million, a 7% of increase, which reflects our continued investment in physical expansion. The second is right-of-use assets. It mainly related to long-term leases, rose by about 83 million, or 7% of increase. It suggests we have secured more long-term locations. The third is the sharpest rise came from investments in associates, which increased by 26 million, growing by 66% of. This could indicate new strategic collaborations or joint ventures. And now, let's moving on to current assets. We saw an increase of around 86 million, also about 6% of growth overall. Our cash and cash balances grew by 44 million, which is a positive signal of stronger liquidity. The trade and other receivable increased by 45 million, likely due to higher sales on credit. Interestingly, inventory decreased slightly by around 2 million, which could reflect tighter inventory control or reduced overstocking. And now let's look at equity. The company's equity rose by 192 million, an increase of 11% off. The reserves contribute the most, going up by 168 million, suggesting strong return earnings. And the share capital also rose mostly by 25 million. As for liabilities, we saw a total increase of 49 million, or around 7% off. The non-current liabilities increased by 64 million, mostly due to lease liabilities, which rose by 64 million. On the other hand, short-term borrowing dropped sharply by 67 million, a 33% of decrease, which indicates reduced reliance on short-term financing. One area of concern is the deferred tax liabilities, which decreased by 4 million, nearly half the previous balance. This may require closer attention in further adults. In summary, Mr. DIY shows healthy and stable growth. We increased the total assets and strengthened equity, improved our cash reserves, and significantly lowered short-term debt. While long-term lease obligations has grown, this aligns with our expansion plans and reflects a sustainable path forward.
Target to open at least 190 new outlets by 2021, and we are investing in supply chain automation to improve cost efficiency. And our international markets, especially Indonesia and Philippines, are performing well. And we aim to increase overseas revenue from 2% to 5% within the next year.
Okay, continuing CEO. Continuous growth will come from online channels and flagship store upgrades. Our e-commerce GMV rose 32% last year. We have launching new AI-driven condition features and cross-store warehouses in Singapore and Indonesia. Offline, we will upgrade 8 to 10 flagship stores to enhance customer experience and drive service.
Okay, and I have another question. The investor care about the profit quality and returns. How does your company ensure sustainable earnings and provide shareholder value?
Despite the expansion, we maintained New net profit at ringgit 568.9 million and declared 5-cent dividend with a 70% payout ratio. Our ROA is 50% and strong cash flow from operation supports both reinvestment and returns. We are committed to stable long-term earning with low financial leverage.
Our net profit fell due to one-time marketing investments, but gross margin stayed at 39%, showing pricing power. We maintain our 30% dividend payout and operating cash flow remain positive at 218 million ringgit, with minimal debate. We have financially strong and prepared for recovery.
Okay, thank you. Okay, thank you for your good answer, David and Yanqing. And also thank you for your constructive question. So, Levin, you're the risk assessor today. Do you have any question you want to add on?
Yeah, of course. David, Yanqi, nice to meet you. And my question is what major risk your company currently face and how are you going to fix it?
Okay, I think the one key risk is inventory and store management as we scale. And we are strengthening digital tracking and real-time logistics to reduce stock out and overstock. Additionally, administrative costs have increased and we are addressing this by training local managers and automation store level reporting to improve efficiency.
Okay.
Okay. Our challenge lies in cost control and competition in fashion retail. While branding is essential, we are optimizing marketing budgets and shifting to more digital ad to reduce cost. We also face inventory agents risks, so we have accelerated inventory turnover through centralized plan and flash deals.
Okay, thank you for your answer. DIY. My first question it is focused on risk. With the large capex committed to rapid store expansion, how are we evaluating the return on capital across region? In a downturn scenario, what measures are in place to prevent over-expansion risk?
Closely monitor our store level ROI using KPIs such as same-store sales growth and payback period, typically under 24 months. In the event of economic headwinds, we are prepared to scale high expansion, prioritize high-yield areas, and pause underperforming rollout plans.
And my second question it is in light of inflationary pressure and currency risks, what pricing, procurement, and hedging strategies are in place to protect margins and maintain customer affordability?
Maintain a mixed pricing strategy. We are maintaining a mixed pricing strategy. Lowering prices for essentials while allowing price flexibility for discretionary items. We hedge against FX fluctuation for critical imports and strengthen our in-house brand sourcing to improve margins and bargaining power.
First question, it is Pardini as a fast fashion carriers inventory and trend risks. How do we manage excess inventory and adapt to rapidly changing customer tastes?
Okay, we employ a low volume, high-frequency production model with product reference cycles. This minimizes sparking planning and improves sell-through. Seasonal clearances and aging merchandising help us keeping inventory through overhead.
Okay. And my second question it is focused on strategy. As we expand into Southeast Asia and the Middle East, how are we ensuring our brand and operations are culturally aligned with the local customers' behavior?
We have both regional teams with decision marketing autonomy for pricing and marketing. A centrally run team ensures things while local insight team get product mix and campaign to suit cultural preferences. We are also investing in sharing logistics and digital platforms to support new country options.
That is great. Thanks for your answer. Nice to meet you.
Okay, thank you all for this insightful discussion with clarity on our financial strengths, strategies, and risk mitigations. Now, let's polish our narrative for investors, ensuring we showcase the value and growth potential of both Mr. DIY and Pandini Holdings. Thank you all.